Hi, everyone. Welcome to the Cloud9Fin podcast. My name is Ayden Crosby. I'm a distressed debt reporter here in New York. Today, we're going to be talking about significant risk transfer, and I'm joined today with David Lucking from Linklaters, a partner in the US Structured Finance division. Welcome, David.
Thanks very much for having me.
I'm wondering if you could start, just maybe describe what a significant risk transfer is.
Yeah, absolutely. And even the mention of significant risk transfer, some people might debate the name. So we hear a lot of different names for this product: credit risk transfer, capital relief trades, significant risk transfer, synthetic risk transfer. So it's a real sort of ABC of jargon. But essentially at its core, an SRT, and that's the terminology that I'll probably use today, an SRT is a tool that banks use to transfer credit risk off their balance sheet and in return obtain capital relief from a regulatory perspective. And so it brings efficiency to the bank's balance sheet. They're not only used for capital relief purposes. There are other good reasons why a bank might want to manage risk that's on its balance sheet, whether it's just freeing up the balance sheet for new opportunities or growing business so that they can increase the amount of lending that they do in a particular sector, or with respect to specific counterparties or counterparty types. So there's a lot of good reasons for entering into these transactions, and we've really seen an increase in the last couple of years, particularly here in the States, with interest in SRT transactions.
And I'm curious what you, in particular, are up to at Linklaters with regards to these transactions.
Yeah, so we have a really global team that focus on SRT. So myself and my team here in the US have really been very active in the last year or two, particularly following the really helpful guidance that came out of the US bank regulators. But even before that, our colleagues have been heavily involved in Europe for many years in SRT transactions. And it's really fair, I think, to say that the European SRT market is at a much more mature state than what we are still sort of building here in the US. But we've been advising clients both on the bank side or as issuers of SRT, but also in connection for investors who might be investing in SRT transactions or counterparties on SRT transactions. And we're also heavily involved with insurers, particularly, again, in Europe, where insurers are really eager to access the exposure that these transactions provide. And so being involved with some really interesting repack-style transactions that give insurers exposure to SRT risk.
Yeah, interesting. And you started to sort of talk about some of the differences between the market in the US and Europe. I'm curious, of course, these transactions are come under different regulatory regimes in each place respectively. I'm curious if you could just sort of describe those regimes and perhaps a little bit how that impacts the structure of these products.
Yeah. So, all of this really comes down to sort of regulatory impact and getting the right regulatory treatment. And so it's really critical to have a legal team involved that really understand the regulations. There's a whole range of different regulations that might touch on SRT transactions. The first or sort of most specific, I guess, for SRT is the capital treatment that the product gets. And obviously, the capital rules that apply to banks are different in different jurisdictions. On top of that, for example, in Europe, with their capital requirements regulation, there is a specific framework for significant risk transfer transactions. We don't have anything akin to that really in the US. We're really going off, the existing bank capital rules. But as I alluded to earlier, back at the end of 2023, the US bank regulators, the Fed in particular, came out with some really helpful responses to some FAQs that they published, providing some clarity around the treatment for SRT transactions in the US. And as you said, that regulatory the regulatory piece really guides the structure of the transaction. So in Europe, for example, we see a range of different transactions, and in particular, different instrument types that are used in order to transfer the risk. In the US, the regulatory guidance that came out from the Fed was really helpful in clarifying that credit-linked notes that are issued by a special purpose entity will get classified or can benefit from being classified as synthetic securitizations under existing US capital rules. On the flip side, they also came out with guidance around bank-issued credit-linked notes, and have put in place a requirement for banks to actually go and seek approval from the bank regulators for certain SRT transactions that are directly issued by the bank. That said, we also see in the US bilateral transactions, so purely contractual arrangements without the issuance of any form of security. That could be by way of, say, a portfolio credit default swap. But again, the regulations are going to drive who might be able to do that. So the capital rules will only provide relief if certain types of counterparty are actually providing the protection. And so the structures have evolved where maybe you will have a second bank intermediating certain transactions as between a bank and an end provider of the protection. There are other regulations as well that people need to think about as well. Coming out of the financial crisis, obviously things like Dodd-Frank have more general application in this area, including requirements around, if you're doing a credit derivative, is it structured as a portfolio credit derivative that would be regulated by the CFTC, and then the knock-on effects for that in terms of the SPV that might be entering into that transaction. Would it be treated as a commodity pool? Or alternatively, can the credit derivative be structured as a series of single-name credit derivatives that are regulated by the SEC and don't come with this commodity pool challenge? So really a whole plethora of super interesting issues for me as a partner at a law firm, perhaps though slightly more sort of challenging for investors. So really requires a certain level of sophistication in the investor base. And also for the bank issuers, there are so many banks in the US, and this is a really valuable tool for those banks in terms of managing their balance sheet, managing credit risk, looking at capital. However, it's really, this is a complex product. And so sometimes, we haven't really seen the explosion of new bank issuers in the SRT space. I think because it's taking, regional banks and others a little bit more time to get really up to speed with all of these different regulatory considerations, as well as, the other operational and structural pieces that they need to put in place in order to do the trades.
Yeah, I'm curious if you could maybe sort of on a macro level, just describe some of the main structural differences you see between the US and Europe. So at their heart, they certainly rely on similar technology. Mm-hmm. I think one of the key differences maybe that we've seen is sort of the tool that is used by the bank to transfer the risk off its balance sheet, particularly where there's an SPV involved. In the US, I think we have tended to see the use of more derivatives tools. So
a slightly bespoke form of a credit derivative. In Europe, I think it's more common to see financial guarantees. And again, some of that is regulatory driven in terms of, well, how is that financial guarantee characterized from a legal perspective? In the US, there's always the risk with guarantees that maybe they would be recharacterized as insurance. That opens up a whole different range of legal issues, particularly in the US, where insurance is regulated on a state-by-state basis, and so can get quite complex. Whereas in Europe, and from an English law perspective, I think there's a slightly clearer line between a guarantee and insurance. So that's certainly one of the key distinctions, I would say, in terms of how the market has developed.
And maybe you could also just walk through sort of some of the pros and cons of those different types of structures. I think particularly because, in the USCC structure look a little bit more like a credit default swap or something like that. But SRT is very distinct from that, and there's a reason for that as well. So.
Yeah, so in terms of reasons why you might choose one structure versus another, certainly some of that can be or will be driven by the issuer itself, but also some of that will be driven by the investor type. I think there are certain advantages, obviously, by doing a slightly simpler structure from a speed and execution perspective. And so, for example, the bilateral or the guarantee route can be a slightly faster execution. In the US, I think people have migrated towards the SPV structure with a credit derivative. Partly because we know that we've got the clarity from the regulators. And so I think that is a real driver there. But also because certain investors and their investor mandate, either requires them to enter into securities or purchase securities, or may restrict their ability to just do a bilateral transaction. And so purchasing even from a private placement transaction, a security may just be easier for them from their investor guidelines or mandates that what they can actually invest funds in. And so we've definitely seen in the US that probably the favored structure is one that involves the issuance of securities out of an SPV.
And yeah, you mentioned a couple times this regulatory clarity that's started to come in the US. I'm curious if you think that's spurred demand for this product to a level that you would have anticipated with that kind of clarity, or is it what does the market kind of look like?
Yeah, I think it's definitely meant that for sophisticated institutions, they are now much more comfortable in the US using SRT as a tool for managing their capital. And that's probably why the vast majority of transactions that we've seen issued in the US market to date in the recent past have been transactions where actually the bank that's benefiting from the relief is one of the GSIBs or is a large sophisticated bank. Not exclusively, but I think it's certainly fair to say that has been the majority of US issuances. I think there are a number of reasons why things have. I think that regulatory clarity and the FAQs from the Fed was incredibly valuable in that respect. But I think it also was happening at a time when there was an expectation with the implementation of the Basel III endgame that capital requirements for large banks was also going to increase significantly. Now, we don't have, we're not even sure what's sort of going on really with the implementation of Basel III at the moment. With the new administration, we're in sort of wait and see mode, a number of changes at the Fed, particularly of key players that were involved in the proposals around the implementation of Basel III. And so, we are still in wait and see mode in that respect. But certainly, the last couple of years, the mood music was that large banks are going to have to set aside much larger amounts of capital, and so it suddenly renewed an interest in this tool. I think also in terms of where interest rates were at and how they've come down, that has been a favorable economic environment, and particularly for banks that have very high credit assets, so good performing assets, but where the capital charge is relatively high. And so, all of those things I think have really encouraged banks to look at how they can be more efficient, and also thinking about preparing for the future in a world under Basel III. Obviously now with sort of a delay with Basel III that is having knock-on effects also in the UK and in Europe with the regulators there putting a little bit of a hold on the implementation over there, waiting to see where the US lands so as to ensure that they're not disadvantaging European and UK based banks. I think, time will tell as to whether or not, once we have that clarity, what that means for this market. But I do think that certainly those banks that have already issued, are recognizing that this is a valuable tool, certainly from a capital perspective, but also from a general balance sheet management perspective. And so I think, hopefully this is a product that is really here to stay.
You mentioned the new administration, and I'm curious how you foresee sort of the regulatory landscape under the new administration and sort of what they can do and can't do.
Yeah. I mean, I think, clarification is always really, really helpful. I think a continued trend of looking at ways to sort of clarify the areas of gray in the capital rules. I think looking, for example, at already the guidance that they've given with bank-issued CLNs, and maybe now that they have had an opportunity to review what certain banks are doing and taking that on board, maybe that opens them up to being a little bit more permissive in that area, or frankly providing further clarity. They have helpfully provided the ability for banks to go to the regulator and say, okay, we're going to issue this type of credit link note. Is this approved? And the regulators have generally said, yes, that's fine, and you can do similar transactions. But there's not a ton of guidance around what they really mean by similar transactions. Is it similar asset class? Is it similar structure? Is it something with similar maturity? And so a little bit further guidance around that would be helpful. I think also, thinking about this as a market that insurers are interested in, looking at whether or not there is the ability to open up the market and provide with essentially an amendment to the capital rules that insurers or certain types of insurers would be eligible to provide this protection. Would obviously be, very helpful. I think on the flip side, or sort of in parallel, it all also depends to some extent on what happens with the capital requirements themselves and how onerous they are in any reproposal. I think the regulators, it would also be very helpful for them to just signal timing around that, and when we might expect to see a reproposed set of rules and, potential timeline for implementation, etc.
Yeah, you've talked about insurers a few times. I'm curious what some of the roadblocks that insurers have in entering the market. And, maybe we could just speak about those more generally.
Yeah, so a couple of things. In Europe in particular, a challenge with insurers is the fact that generally they provide protection on an unfunded basis. So they will write an insurance policy, and you're essentially relying upon the fact that this is a very highly capitalized entity. They're not necessarily posting collateral or funding up front. And so structures have developed such that rather than the insurer providing protection directly to the bank under an insurance policy, the bank will transfer the risk into a repack vehicle that will issue a note, and the insurer will insure that security, which is business that insurers do all the time, providing wraps around structured notes, and in that way the insurer gets exposure to the risk that they're looking for, but they are not themselves directly providing the protection to the bank. On the US side, it's a slightly simpler challenge in the insurance companies at the moment are just not eligible within the capital rules to be a provider of protection. And so, that is something that frankly we would need to, change at a legal level.
I wanted to go back for a second to the new administration and some of the volatility that we've seen in the market. We put out a piece, I think a couple of days ago, about just hearing some investors pushing back on certain terms. I think the piece specifically was talking about these replenishment terms, which is what allows banks to, I guess, from my understanding, correct me if I'm wrong, change the underlying package of loans.
Yep.
I'm curious if you've heard of any other sort of responses to the market like this, or just terms kind of trying to be changed. Anything that's cropping up that's interesting.
Yeah, well, the first thing that I would say is I think a lot of, going back to my point on the regional banks, I think a lot of regional banks are sort of looking at their portfolios of credit and wondering whether some of the new policies of the new administration around tariffs, et cetera, might be impacting small and medium-sized businesses that the regional banks are more likely to be lenders to than perhaps, the GSIBs, and wondering what to do about that, or if there's a way to sort of, make sure that they are managing that potential unrealized losses that are on their balance sheet. So I think that is absolutely something that people are very focused on, and presents the potential for regional banks to be, pushing more strongly to potentially issue SRT in the coming year. I think otherwise, more generally, I think there is some focus on just looking at with the sort of changing credit cycle, looking at terms that are in the transactions, ensuring that the credit events or the events that might actually trigger a payment under the transaction are suitable for current market dynamics. And I think that's important to do continually, particularly as we see new things happen in private restructurings of loans and things like that. It's really important for the product to continue to adapt to developments in out-of-court restructurings, etc. I think in terms of the replenishment criteria. A lot of that is very sort of commercially driven. But yes, certainly there is always one of the key areas where you would end up spending quite a lot of time in terms of a transaction where replenishments or changes in the portfolio are permitted, particularly if the pool is a blind pool, i.e. that you don't actually have all of the name, the investor doesn't know exactly what is in the pool, is making sure that, the criteria that can be used in terms of choosing what goes in the pool are robust enough and tailored enough to the types of risks that the investor has appetite for.
I want to go back for a second. You mentioned these sort of different credit event triggers and how those might evolve under, I cover distressed debt, so we're always, reporting on wonky sort of out of court restructurings. And we've reported a little bit on something that doesn't seem super common, but these, parties pushing for certain new credit event trigger for like a distressed asset sale. Just kind of trying to change the goalpost of when something is actually considered, when a loss is triggered. I'm just curious about your thoughts on that.
Yeah, I think that's a great example of the market sort of looking at what is happening in the broader loan market and the loan restructuring market. There was a case recently in the UK, the Galapagos Group case that I think is relevant to that. I think it's relevant to also thinking about how terms in the underlying loans are evolving. And so it's responsive to that in terms of, giving, for example, certain sale rights in a distressed scenario to senior lenders, which I think the credit event that you're talking about is sort of targeted at, ensuring that any losses that occur there would still be covered by the protection that's being purchased. But that's why I think it's always important to be sort of regularly evaluating, what is going on in the underlying market, and as a result, that investors have a good handle on the types of asset that are going into these SRTs. We've seen a really broad range of different assets in the last year or two, ranging from more typical traditional securitization assets like auto loans, but through to BDC loans and infrastructure loans and things that are much more complex, even though they may also be high-performing assets. And so we are, it's really important that the investor sort of understands how those underlying loans operate generally, because different asset classes in the loan market may have slightly different provisions or market conventions, etc.
Interesting. Yeah. It'll be interesting to see how, I think, especially with the proliferation of private credit, be interesting to see how that all kind of shakes out. One final question for you. I'm just curious what kind of market participants are dominating the market in this space. Yeah.
Well, so obviously on the one side you have the banks, but that can be a real range of size of bank, and also it only works for banks that are in jurisdictions where they're going to get the capital relief. So we've seen obviously the European market, be very robust. But Canada, a couple of years ago, the market really started to grow in Canada, and then most recently in the US. We haven't seen as much activity in Asia, frankly. I think there are some challenges with the Australian regulator for the Australian banks. So, on the one hand, you've got the banks and thinking about the different capital regimes that they are subject to. Then on the other hand, you've got a real range of investor types. I think insurance companies as an investor is so rather than actually providing an insurance policy, but actually acquiring a security, that is a big group for this market. But beyond that, there are very sophisticated funds that either have an SRT strategy or that have even set up their own fund specifically for the purposes of investing in SRT. But also, there is becoming an overlap between investors in the more broadly syndicated securitization market and certain SRT issuances. So it's a real range of investors, which I think is, healthy, not always great for spreads necessarily, but good result for the banks that are looking for more economic protection. I think it's always really healthy to have a robust, a wide range of investors. And also from from the perspective of the regulators, to know that the risk is being broadly disseminated and not concentrated, I think is a healthy thing for the market. As I say, we've seen really high performing assets in the US, and so this is very different to the products that we were seeing in the mid 2000s. But I still think, there's real value in sort of having that risk syndicated across a variety of partners.
All right. Yeah, I think I'll wrap it up there. Thanks so much for joining us. I appreciate it.
This is great.
And
thank you.
Yeah, thanks so much to everyone for listening. You can email our podcast team if you'd like to engage more, and hope to see you in our next episode, which I don't know what it'll be about, but awesome.
Great.
Thanks so much.
Thank you.